welcome to the Wealth Renegade podcast. I'm your host, Robbie Butler. Have you celebrated your financial independence today? Today, I'm so excited to have my good friend Steve Sue on the podcast, ophthalmologist, investor, and an author as well. Steve, thank you so much for being here.
Thanks for having me on, Robbie. I'm looking forward to it.
Yes. So I mentioned author because we'll get into your book and the experiences that led you to write this book, which I read, I give the book away freely because of what it describes about the thought models a passive investor needs in order to be able to think correctly about their opportunities. But you've got several other fascinating pieces of who you are as an investor as well, including the LeftField Investors. So we'll get into all of that, but I would love to go back to the core, to the philosophy which keeps you so engaged with your investing. Can you tell us a little, what is what's your main driver for private placements? Why do you feel that these types of investments are the right fit for you?
Mhm. Well, if we go back to my story, I'm a physician and I don't have a whole lot of time in general since I am full time. And go back to my investing history. Of course, I was back in the late 90s, early 2000. I was doing some, well, I call it night trading, not day trading, because I was buying individual stocks just like everybody else was, and their mother and father probably. But anyways, I got caught up in that excitement, if you will. And then I still had a lot of money in the stock market at that time. Actually, I still do, and we'll get to that in a second, but lost a lot of money in 2000, 2001 when the market crashed, when the tech boom crashed. And then fast forward a few years later, around 2008, 2009, there's another pretty big stock market crash, as everybody knows. So I thought to myself, well, I probably need to do something a little bit different, at least diversify my money outside of my 401k and investing my money outside of the qualified plans. So I decided to look into real estate. I read, like everybody else in real estate, read Rich Dad Poor Dad, and that kind of got my wheels turning. I started to self-educate. I did some in-person real estate education, that kind of thing, and also bought some home study courses. And so I started out doing some active investing. Started out with my own office condo where we practice, and still that's the only active real estate investment that I own right now. And I did have a short stint in some small residential houses, but I decided not to do that because I thought I was a bad landlord. And even with property management, I still just didn't like it. It just wasn't for me. So I stumbled upon, somewhere along the way, I stumbled upon syndications or private placements, as you say, where you invest money with a sponsor or syndicator who manages the asset, and they may either have their own property management or they have third-party property management. So I looked into that, and I still have, in terms of my investable portfolio, I have probably half of my money in my 401k. Since I still work full time, I have to keep it in there. So I'm in a lot of mutual funds. And then my other half is in real estate syndications.
And yet, if I remember from your book correctly, you're also involved in several niche asset classes. Is that true?
I'm in, boy, I think about 15 to 20 different types of asset classes. And one of my lessons or chapters in my book is about diversification, to kind of talk about my syndication journey. Unfortunately or fortunately, my first syndications were in oil and gas, and I looked at the returns. I thought, this is fantastic. I get great tax benefits. Unfortunately, after about 2 or 3 years, the money that I was getting from the returns from the oil and gas exploration started to peter out, and the communication also started to peter out. And I thought, what's going on here? And so fast forward a few years later, I learned that this was more or less a Ponzi scheme. Unfortunately, a lot of the oil and gas syndications have ended up being Ponzi schemes. And I'm not knocking out the oil and gas industry. There's certainly a lot of great sponsors out there in that asset class, but I got caught up in one of those Ponzi schemes. So I started looking into more true real estate, such as resorts and coffee farms and that kind of thing. So I kind of got into I guess I got into more exotic syndications, if you will, initially, and then I finally settled upon multifamily, self-storage, and those kinds of things as well. And again, one of my lessons in the book is about investing in boring assets, because those are really the things that are going to make you steady money. And it's a lot less risk. Things like coffee farms and development deals, resort deals, those kinds of things, especially in international territories, are more development deals, and those don't cash flow. So I've learned along the way that the cash flow is for me one of the most important qualities of a syndication, because as you get $1 back from your $50,000 investment, you're de-risking that by a dollar. So if you get steady cash flow along the way, you're de-risking your investment. You're getting some of your investment back. So if you wait for a development deal to process, it's going to take 2 years, 3 years before you get anything back. And if there's a big recession that hits, maybe that development deal may go under. So there's a lot of risk, and then you had nothing back from that. So I think it's really important to not only diversify, and like I said, I'm probably in 15 or 20 different asset classes right now, but I think it's also important to look at, when do I get my money back from these deals?
So most people have got some type of hairy experience once they've been investing long enough, whether that's in their equities or in their syndication opportunities. But you had some early ones that were pretty harrowing, unpleasant, and
Mhm.
not only unpleasant because the deal went south, but the deal went south because the fundamentals of the deal weren't there. There was no trust with an operator. They weren't able to run an honest business, clearly, given that they were using some investors' money to pay back other investors.
Mhm.
What do you think it is about your investing philosophy that allowed you to persist through that and not to wash your hands of all syndications and say, I'm gonna go buy Apple until the world changes? What kept you persistent?
Yeah, everybody asks me that same question when I'm on podcasts. So yeah, it's true. I didn't make any money. Obviously, well, I lost money in my first few syndications, and then even in my, I call it my second tranche of investments, I did these exotic things like coffee farms and resort properties and that kind of thing. I'm still in those deals, but I have hardly seen anything coming back from those. And then I got smart, and in my third tranche here, I've been doing much better. But if you go back, I lost money in the stock market too. I lost a lot of money in the stock market because I was day or night trading, whatever you want to call it. And I lost a lot of money when my financial advisor was also handling my money in 2008, 2009. I mean, just everybody lost money in the stock market. So I'm not blaming him. It was just the market. So any investment, no matter what it is, you can lose money on. So other than maybe the US Treasuries, I suppose. But anyways, if you look at the wealthiest people, you look at people who are billionaires and multimillionaires, most of them have real estate as an asset class in their investments. You look at a group like Tiger 21, which is, I think you have to have $20 million of net worth,
Yep.
and it's this investment club. And you look at their pie graph, and you can Google this, and you can see that close to half of their investments are in real estate and or private equities. So if you want to learn from people who are more experienced, or at least richer than or wealthier than I am, that's probably not a bad model to follow. So I'm very bullish on real estate, and real estate, just like any other asset class, has its ups and downs. But overall, I'm very happy with where I'm at. I'm in over 50 syndications right now, and I'm making a very nice cash flow. And it certainly, even now, it's still not without some headaches, if you will, or some heartache, but I'm still making decent cash flow. And ultimately, once I retire, I want to get to the point where my syndication investments are replacing my income.
You helped to found LeftField Investors, which is a group of investors very focused on private placements, on finding the syndication opportunities that we represent that people feel are more unique. And that's why the left field name, and
Mhm.
center field are people with blended assets, and the right fielders are the more typical equity investors. In that group, so much group knowledge is able to flow, and that's something that
Mhm.
many private placement investors don't get any insight on other investors. They never get to have these types of conversations. They don't get to hear how others are thinking about it. So when LFI was started, how did that change the way you were educating yourself? You mentioned a long
Mhm.
time ago paying for courses, Rich Dad Poor Dad. LFI was a whole different way to get educated. So now that LFI is established, how are you continuing to learn, and what did LFI do to that educational
Mhm.
process?
Yeah, it's been a game changer for sure. When I would say my first two-thirds of my syndication investing was me on an island with no one else there, and I knew no one else doing this. I certainly
Mhm.
knew a lot of active investors, but I knew nobody else doing syndication investments. I did go to a syndication investing course held by the real estate guys, which I actually still have. It's called The Secrets of Successful Syndication
Yep,
or something
that's
like
it.
that. But anyway,
Yep.
yeah. But I really didn't connect with anybody. I was actually looking to maybe be a syndicator at that time, and I really didn't look at it as me being a limited partner in other people's deals, even though there are some people who are syndicating in the crowd. So, anyways, yeah, LFI or Left Field Investors has been a game changer for me, and I think for thousands of other members because now we can talk about XYZ sponsor. We can talk about ABC deal. We can talk about this asset class or that asset class. And we have a very active private forum where people can, I hope, can talk freely without any fear. There are some public forums out there where I think people kind of hold back and don't want to name names and that kind of thing for fear of any backlash. But we, in this private forum, we're constantly talking about other sponsors and what their experience has been with that sponsor and that kind of thing. And that really shortens your learning curve and it saves you a ton of money because if I invested with that oil and gas indicator, if they were still in business, of course, I would be saying, hey, do not talk to these people. These are not good players. And I may have saved somebody potentially hundreds of thousands of dollars because they may have lost money in their Ponzi scheme, whatever. So, or this sponsor is a bad communicator. I have no idea what's going on with my deal right now. I'm barely getting any. I'm getting a return maybe once a year on this. So these kinds of experiences are invaluable because you don't have to make every mistake. I mean, I didn't make all 20 mistakes or lessons. I didn't learn those by myself. Some of them are lessons that I've learned from other people or other investors. And so fortunately, I've been able to use their advice and not lose more money. So by you just really magnify your education and shorten the learning curve. And as a byproduct, you probably save a lot of money too.
Mhm. And some of the heartache you mentioned is so
Right.
rife in investing. You are putting money out and you are working for it to come back, but that process has its own bumps in the road and its own challenges. You mentioned 20 mistakes because of the title of your book is the avoiding rookie errors as a left field investor. The book is so clean and clear about the ways people can avoid some of the things that turned you upside down in your early days of private placements. Since writing it, have there been additional lessons? Is there a 21st one you would put in there? Is there more that you'd say, yes, this is a new element of your diligence?
I was thinking about this the other day. I was listening to another podcast and some things came up and I was like, oh yeah, I should. I mean, if I were to write a second edition, it hasn't even been a year since it's been published, but I'm thinking about writing a second edition. It is a rather short book. I mean, it's not more than 60 some pages long, so you can read it easily within an hour. But yeah, I'm trying to think what I would put in there. Might have to do with maybe if you break down the syndication, you have the asset itself, you have the location, and then of course you have the sponsor or the syndicator. So I, I like to say that the sponsor is probably 80% of the success of the syndication. And then maybe 10% is the actual deal and 10% is the location. Because like a lot of people will say in this business, bet on the jockey, not the horse. I mean, I'm a tennis player, and if I played with Roger Federer's tennis racket, I'm not going to be as good as Roger Federer. But if he played with a wooden racket, he would beat me so badly, even with my racket, that it wouldn't be funny. So, yeah, a good sponsor can turn around a bad deal. Well, they probably wouldn't be getting into a bad deal, but maybe a little bit more high risk deal versus a bad sponsor can run an A class property into the ground. So I would always bet on the sponsor. So that's something that I would definitely emphasize. I kind of allude to it in my book, but I would definitely make that maybe a separate lesson is to definitely make sure that the sponsor is the absolute person that you're going to be looking at versus the location and the actual deal itself.
It's amazing. So as we wrap up here, and you, the listener, should be looking for all the areas that you can get more education. And Steve's book is such a concise way to spread your thinking across multiple experiences he's had over his investing time. Knowing what you know now, being a part of Left Field Investors, writing the book, being in 50 different syndications, knowing your cash flow philosophy is clear, how do you make your asset allocation decisions? What's the theory behind it? Are you open-minded? How do you make those decisions now that you've got so much of a track record yourself as an investor?
Mhm. Yeah, that's been an evolving pursuit, I guess, is trying to figure out what the ultimate asset allocation is. Like I said, I do have half of my money in my 401k, so that money is kind of stuck in there until I can draw it out, and I don't plan to pay that 10% penalty to take it out and pay the taxes on it. So I'll just keep that in until I can actually take it out in a much more efficient manner. But anyways, with the syndication investing allocation, if you will, yeah, again, I think cash flow is really very key. And right now, I'm working full time as a physician. I make a decent income, so I don't really need necessarily the cash flow, but I just want to de-risk every single deal that I'm in. And so I want to look at cash flow. I don't like development deals at this point. I did a bunch of them at first, and I'm still in them, unfortunately, and I haven't seen any money from them. So I think just getting into deals that have a decent amount of cash flow is fine. Certainly the best ones would probably be a debt deal, for example, where you get a certain percentage back, 8, 10, 12% back, and then you don't get anything on the back end. And that's fine. I don't necessarily need to have a lot of my allocation into debt deals like that because I do want to have some appreciation, obviously. But that's what I mean. Everybody's goal is to have appreciation. But so you have to look at risk adjusted returns. You want to look at a deal, for example, if it's a self storage deal, you want to look at that deal and say, okay, cash flow is pretty decently. I might get 6% cash on cash return. And then when the asset sells in 5 or 6 years, I may get a 1.8 equity multiple, which is great. So at least I've gotten 6% back, or on average, let's say over 5 or 6 years. So I may have gotten 30% back, 30% plus back. And so then I get a nice little bit bigger nugget at the end at that point. And if they hold on to it longer, that's fine. I just keep cash flowing, but at least I'm de-risking it every year by getting this cash flow back. So I want to look at that first and foremost. And I do put a small portion of my money going forward. I will be putting a small portion of my money into more risky asset classes and plays and things like that, because yeah, you might hit that. Well, I do things like these pre-IPO, so put a few $100s, few $1,000s in some of these things, and they may go 20x or 100x. So I do have put a very small amount of that in there. It's kind of play money. If I lose it, okay, that's it. I didn't put a ton of money in there, but if they hit big, then I could get a 30x or 40x on those deals. So that's kind of nice too. But yeah, for the most part, I'm going to go with boring asset classes, multifamily, self-storage, mobile home parks, RV parks, car washes, those kinds of things. Those are boring assets, but they cash flow well, and there's some good upside on most of those.
Very cool. If people want to reach out either to you or to Left Field Investors, how can they get in touch?
Yeah, so the easiest way would be just to email me. It's steve@leftfieldinvestors.com, and they can reach out to me. I check my email frequently. I'm hard to get on the phone, though, unfortunately, because since I work full time, but I'm happy to get on a call, maybe after hours. But that would be the best way to reach me. And then, of course, our website is leftfieldinvestors.com. We have a ton of free resources on there as well. And if you want to join the Infield, which is the Inner Circle membership group, that's a few $100s a year. And then, like I said, you can really ramp up your education and decrease your learning curve by joining the Infield mainly because of our forum and our opportunities. We have virtual networking opportunities almost every week as well. And then we sometimes have some meetups live as well.
Steve, thank you so much for being here. It is great to have you, and your book is such a resource for passive investors looking to chart a safer course than what you might do if you're out on the island yourself. So, thanks so much for being here.
Thanks again for having me on, Robbie.